Brad, thank you for joining us today. Part of this interview is to get some more information about BMT and the services that you can provide property investors. As you know, I have access to quite a few property investors within my marketplace, and I want to make sure that they have the most detailed information that they can about your product and service, just so they can make an informed decision on their investment property. Can you share with me what BMT offers in the way of a product and service for their investment, and how you can help them grow and get the most benefit out of their asset?
Well look, Tara, it's quite simple. We prepare depreciation schedules, which effectively means more cash flow out of the property. So depreciation is things in the building are getting older and wearing out, and the tax office says we're allowed to claim part of the cost of those things each year as a tax deduction, and part of the building as well. Effectively, it's a tax deduction that many people are not really claiming properly. So what we do is we go in and we look at it properly, you can see what you are claiming and making sure you're getting the most out of that investment. And effectively, it just means more cash for property investors.
Absolutely, and I do a lot of listing presentations, as you know, so we're always wanting to give as much information as we can to our clients, and the one thing they come back to me and say is, can't my accountant just handle this? So can you just share with me how that works for you guys as well?
Look, and that's probably the most regular question we get as well, is doesn't my accountant look after this? He does my tax returns, and the simple answer is we work alongside the accountant. There's a bit of legislation that says that the claims need to relate to a construction cost, and as a quantity surveyor, as we are, we estimate construction costs, so the tax office accepts that. So there's a bit of compliance, but it's more about we work with the accountant to provide one of these numbers for the tax return, and we make it as high as possible and sort of take the risk away from him on that construction costing, and also you as the client away from you on that construction cost part of that depreciation claim.
Excellent. Now, I'm in a marketplace where we have a huge variation of old and new properties. We've got some beautiful new developments. We've actually got some really old heritage homes, some that are 100 years old. So can you just explain to me the difference? Is there a benefit for those that have those older age properties right through to brand new properties as well?
Look, it's the second most regular question an investor asks, but it's not new, Brad. Because a lot of people understand new property gets depreciation, or near new property gets claims as well. Really old property still gets some depreciation. It will relate to work that's been done maybe, and certain dates that matter out of when it was built and things like that. But effectively the simple answer is old property still gets depreciation. It doesn't get as much, but we'll be able to have a look at some photos of your property. We can find them on the internet these days, and give an indication of what sort of deductions might be available prior to you going ahead and ordering any depreciation schedule. So it still gets depreciation on old properties, just not as much, but we can get an indication before we do anything.
So probably the best thing moving forward, whether your property is positioned in the older market or in the newer market, is to actually come and have a conversation with your team and find out where they are positioned, and get an idea as to moving forward if they should have that tax depreciation done. I'm sure your team do have those open conversations with investors all the time.
Most definitely, and look at an email of what the address of your property is. Brad, I've got this property at 16 Smith Street, and what sort of deductions do you think I would get out of it? And we'll be able to have a discussion then, and we can come armed with a bit of information before we even have the phone call. And we can do that over the phone. It's really easy. It doesn't cost you anything.
It's free.
It's free to have a discussion about whether or not we'll get some deductions. If we think we're going to, then we go ahead and do it, and obviously then it costs some money.
Renovations is another key area that investors go through. So whether it be that the tenant's still in place during the renovations, or the tenant vacates and they're going through that process, they're always wanting to get some claim or some way of getting recoup costs of what they've had to outlay to have the renovations completed. Does this come under the tax depreciation side as well, Brad? Can you share with me how that works at BMT?
Definitely. There's sort of two things to consider when renovating. We'll talk about after the renovation first, which is a bit wrong, but when you renovate, you change what's there. So you change the cost of what's there. You add more things to depreciate effectively. So depreciation on those new things is very important to make sure you assess properly and get all your claims for those. But before you renovate, it's also very important. The things that you throw away, or as we term scrap, still maybe had some value left. So the good thing, the thing you need to do is make sure you've had it assessed first. Your existing depreciation schedule, if you already had one, is important there, because a lot of those things get written off straight away in that financial year when you do that renovation. So get in first to have a look at it, and then just adjust it afterwards for what you've done as far as work's concerned.
Now, looking at a fully completed house, people tend to look at tax depreciation of building, but there's also the appliances and features and stuff in the property as well. So where does that start and where does that end? Is there a fine line of where you can define that, or obviously every property can be different as well?
Look, the tax office puts out a list of these things effectively, and depreciation's got two areas. One's the claim you get against that structure of the building, and the other is for what is called plant equipment or fixtures and fittings. And that ranges anything from the carpet to hot water service, stoves, blinds, curtains, your microwave if it's built into the wall, your clothes dryer if you own it and provide it to the tenants. Anything you provide to the tenants that you own that's kind of mechanical, or there's a list of these things, and we've got apps that list the things out, you get higher claims on. So the more of those things that we can find, the better for deductions.
Yeah, look, thank you so much for sharing that information with us today. I know that the investors that I deal with on a day-to-day basis will really appreciate that, and I'm sure that you'll be getting some more calls after this session today. All your details will be made available at the end of this video as well. But thank you again for your support, and looking forward to seeing how things go for you in the new year as well.
Great, thank you very much.
Thanks, Brad.